one of the partners of asset-based lending. We're a hard money lending firm based in New Jersey and one of the largest lenders in the area. We're going to talk today about term financing for rental properties. And I'm on with our colleague, Joe Viganola from Cardinal Financial. Just briefly about myself, and then Joe will introduce himself. I've been in the mortgage business for 40 years and run a bunch of mortgage companies. And I spent 25 years of my career at Morgan Stanley, where I was co-head of the mortgage division there. I was president of Morgan Stanley Home Loans and the CEO of Saxon Mortgage, which was a Morgan Stanley subsidiary. I'll let Joe introduce himself now.
Yeah. Hi, everyone. My name is Joseph Viganola. I am a branch manager with Cardinal Financial. I've been in the business about 12 years. I am a licensed realtor in New York and New Jersey, and I've been partners with asset-based lending for about 2 to 3 years now, specializing in takeout financing for real estate investors. Okay,
so I'm actually going to talk a little bit about history and the history of the mortgage market, because it's necessary, I think, to understand it in order to understand where we are today with the difficulties in the term financing market. So going back to the Great Depression, there were only banks that were lenders, and there were about 10,000 banks in the United States. There were no 30-year mortgages back then. There was only a 5-year mortgage. And there was no federal and very little state involvement in the mortgage industry. About 3,600 banks closed and went bankrupt during the Great Depression, and 40% of Americans lost their homes. It was a horrible experience for many families. So in the 1930s, Franklin Roosevelt became president, and he pursued his program called the Great Society. And it had many components, but one of the most important was the creation of Social Security. And he also created the concept of the 30-year mortgage. The idea was people should have good jobs that last their whole lives. They pay their mortgage, they retire, they have a house with no mortgage, and Social Security to survive the rest of their lives. During the Great Society period in the late 1930s, the government created the Federal Housing Administration, the FHA, so to ensure that Americans had access to mortgages insured by the US government. Then in 1938, the government created Fannie Mae. The purpose of Fannie Mae was to buy mortgages from banks, so to allow banks to make more mortgages, or else the balance sheets would get clogged up. And they also created at that point the Federal Home Loan Bank System, which was designed specifically to have money to lend to banks that were doing mortgage lending. So a lot of the modern mortgage market was created during the Great Depression. Then fast forward to 1946, and 10 million American soldiers came home. A lot of them got married, started having families, my parents, and suddenly there was the biggest housing boom in American history and biggest demand for mortgages ever. And Fannie Mae and the FHA were there to meet that demand and help banks during that period offload their mortgage risk to the US government. So that's how the market continued. It was really just banks making loans. And then in addition, there were a few more major government actions. In 1968, the government created Ginnie Mae, and they split Ginnie Mae out of Fannie Mae. The idea was that a lower income and poor people in the country needed greater access to housing. So Ginnie Mae was going to get a complete government guarantee and target those economic classes. Fannie Mae then lost the government guarantee, but still functioned as a government entity. And then in 1970, the government created Freddie Mac, which is essentially identical to Fannie Mae in many ways, and was meant to be competition for Fannie Mae to keep the pricing in the market competitive. But also there was the government recognized that the banks needed greater opportunity to offload the risk of mortgages off their balance sheets, and so the government supported that. Then we come to the 1980s, and a lot of things changed. First of all, the baby boomers were coming of age, and all of them wanted houses, but they also were at their peak earning years and they were saving a lot of money. So things were changing fast. Big demand for homes, lots of cash invested in these new concepts of money funds and investment managers, which didn't previously exist. And so there's a big home for cash, big demand for mortgages. Banks didn't have enough capital to hold the mortgages. So then a gentleman on Wall Street named Lou Ranieri at Salomon Brothers, he's still alive actually, had the idea that he could help the banks by doing something called a securitization. And I know this might sound like, why is Kevin talking about securitizations in this call? But it actually is the core thing that's gone wrong in the market today. So I have to explain it to you. So they had this idea that you could go out to a bunch of banks and buy a bunch of their mortgages that were guaranteed by Fannie or Freddie and put them into a thing called a trust, kind of like a house all by itself. And then we could go out and find investors who were interested in buying shares of that trust. But some investors might want to take very little risk, call them Class A, and they might say, I want my money back as fast as possible. So even though the pool of mortgages might have yielded 6%, they might say, I'll be happy at 2% if I get my money back in 2 or 3 years. So that's Class A. Class B might say, I'm willing to take some risk, but not all the risk. So I'll be happy if I get my money back in a 5% yield in 4 or 5 years. So maybe you do 3/4 of the pool in Class A and Class B, and then you'd find Class C, which was a bunch of investors who said, I really like taking risk on these houses. It's Fannie and Freddie, what could go wrong? But I want a 9% yield. And that's how the securitization was created. And why was it good? It was good because it freed capital up for the banks, but it also created an asset for investors. And there were money managers out there who said, well, gee, I can own a US government security at 3%, or I could get one of these tranches out of a mortgage securitization at 5%, but it still feels like a government bond. So it was a meeting of a lot of things making sense at once, with a lot of money to invest, a lot of people needing mortgages, and the modern securitization was created. So the securitization market grew enormously beginning in 1980. It grew to actually tens of trillions of dollars through 2000. And it expanded to every asset class: credit cards, autos, student loans, equipment loans, airplanes, you name it. Every asset in the world is in a securitization now, but mortgages are the biggest. And there's continued to be huge appetite for it because of the continued savings of the baby boomers. But along the way, something unusual happened. And Wall Street realized that banks didn't have to be the only mortgage lenders. That because of securitization, because banks have deposits, and so with deposits they can fund a lot of mortgages. But because of securitization, Wall Street realized that you could create a new type of company, a non-bank mortgage lender. And those are all the lenders that are doing term financing. Most of the lenders doing term financing on rental properties, which we'll get to in a minute. So what happened is these non-bank lenders formed. And by the way, everyone, Quicken, it's the largest mortgage lender in the country. It's privately owned by one guy, and it's a private non-bank mortgage lender. So what happens is some people will get some capital together, say $50 million from a bunch of investors. Then they'll go to the big banks and they'll get lots of lines of credit. And they could get big lines of credit, say 500 million. So now this company has 550 million of capital, and it starts making mortgage loans just like a bank would. And then every month they go to Wall Street and turn them into securities. And then they reload and do the same thing next month. And that's how the whole non-bank mortgage origination industry got started. Now, originally, they were also only doing Fannie and Freddie Mac loans. They could take their loans and get a Fannie and Freddie Mac guarantee, just like any other bank could. But then in the 1990s, Wall Street realized that there was an unserved market for borrowers who weren't eligible for Fannie and Freddie. And they were called different things. It was called Alternative A because A paper went to Fannie and Freddie. These were alternative. It was called Subprime. Subprime's gotten a really bad name from the 2008 crash, but it actually had a really good name before that. Because in the 1990s, the non-bank originators realized, wait a minute, there's hardworking people out there who have jobs off the books or they're self-employed and they don't run all their income through the books, but look at their bank accounts, there's cash flowing through. They could pay their mortgages, but they can't get a mortgage from a bank. Or somebody who's just gone through a divorce and their financial background doesn't look solid, but actually they have a good job or a health problem. Millions of people didn't fit the Fannie Freddie model. So these non-bank lenders popped up and started making loans that could be turned into securities, and they were subprime, and they performed really well. And that fast forwards to 2000 to 2002. In 2000, there was a stock market bubble in high tech, and the bubble burst, and the tech stocks went down 80% in 2 years. It was a pretty big calamity at the time, but compared to 2008 and today, it was really not much. And the Federal Reserve reacted by lowering rates to 1%, which was the lowest they'd been in 50 years. So then what happened beginning in 2001, 2002, is that the economy was fundamentally strong and rates were very low, and people just took those low mortgage rates and started buying a lot of houses. And house prices started going up pretty quickly. So up until that point, all the securitizations of subprime borrowers did pretty well. But then as house prices went up and up and up, mortgage lenders were finding that they had to lend more money for it to make sense. So unfortunately, things got over-levered. And by 2005, late 2005, the market really started to make no sense. Mortgage lenders were started to lend with zero down, no skin in the game. But they could still make securities with borrowers who had nothing down because the past 20 years, there've been almost no defaults. So everything looked great, everything felt rosy, but no market can sustain itself when the participants have no skin in the game. So it all came falling apart in 2007. And what happened is the entire financial system owned too many of these mortgage bonds that were backed by borrowers that put nothing down. And it was a disaster. The banks weren't capitalized enough for it. And what happened is everything just shut down. House prices went down rapidly because what happened is because all the non-bank lenders couldn't make new loans, couldn't sell bonds, and if they couldn't sell bonds, they couldn't make loans. So relatively quickly, because the bond market shut down, the non-bank lenders shut down in 2008, and it was pretty devastating. So Congress stepped in, and they created the Dodd-Frank Act, and it's thousands of pages long, but the only thing that matters for the discussion today is they created a concept called qualified mortgage, QM. And then they also created non-qualified mortgage. It's sort of the same as before agency eligible mortgage and non-agency eligible mortgage. But Congress created a bright line test of around 43 debt to income ratio to qualify for an agency mortgage. And then everything else is just outside the agency box. And that's what all these lenders are called non-QM lenders. It's all fell out of the Dodd-Frank Act. So here we are in 2010, and there were still almost no non-bank lenders. But there were a lot of mortgage professionals who said, wait a minute, house prices are down 30%. There's lots of people out there with good jobs who understand real estate. There's got to be a business here again. even though the bond market was still closed. So companies started being created. People started putting capital together, getting a little bit of backing from a financial sponsor like an insurance company or a pension fund, or maybe one of the asset management companies like Fidelity or PIMCO. And they would put pools of money together and start making loans to non-QM investors. Now, these could have non-QM borrowers. These could be homeowners, or it could be investors doing rental product, but they were just lenders looking to make solid loans. And a bunch of those pools were created. And then between 2010 and around 2015, billions of it were done, not trillions, but billions, and all the loans performed well. So finally, the money managers in the world said, I think maybe I'm ready to buy securitizations again. So the market was kind of dead for about 7 years for non-QM securitizations. But then in 2015, the market opened up because the loans that were made from 2010 to 2015 all performed really well. So since 2015, there's been over $1 trillion in mortgage bonds securitized for non-QM borrowers. And dozens of non-QM lenders were created and made great loans. The market was in great shape. 7 weeks ago, we had 3% unemployment. Incomes were rising. Mortgage defaults were at some of their lowest in history. And then the unexpected hit, which is the pandemic. And so what happened 6 or 8 weeks ago is that when the buyers of bonds realized that it's possible that millions of Americans were going to lose their jobs and perhaps stop paying their mortgages and stop paying rent, that the bonds they were holding and buying suddenly might not be worth what they were paying. So the market completely froze in mid-March for bond buyers. And in fact, it got worse because there were owners of those bonds who had bought them with borrowed money, and they got margin calls. The bank lenders said to them, these bonds aren't worth 100 cents on the dollar anymore, they're worth 90, you owe us 10 points. And that caused a very rapid liquidation in March of this year and early April, until things calmed down a little bit. So where we are right now is there are no bond buyers. So all the non-QM lenders have gone dormant. Many of them have laid off most of their staff. They're still in business, and these are smart, qualified people who run these companies. And my guess is they're talking to pension funds and insurance companies and private pools of capital right now to try to figure out a way to restart the non-QM market. So I'm going to finish up by saying, where does it go from here, the non-QM market? And then Joe's going to address it as well and talk about what's available with the government agencies and commercial lenders. In terms of the non-QM market, I don't have a crystal ball, but I think there's probably 3 scenarios. Most of them, all of them are better than 2008. The first scenario is that we all get back to work sometime relatively soon, and people pay their mortgages and pay their rent, and the existing bonds turn out to be okay, and the dip in performance is only a dip and not long lasting. And then if that's the case, then I think it's reasonable to expect that there could be securitizations coming back early next year, and non-QM lending could come back strongly in 2021. However, if the economy drags out and people don't pay rent for a long time, say a year, and mortgages for a long time, then the non-QM market's going to be delayed until people start paying their mortgages and their rent again. I don't think it's going to be as bad as 2008 because that was a banking system crisis. The banks had too much leverage. They all got illiquid. The government had to bail them out. We don't have that today. We have the opposite. The banks are all liquid. And more importantly, the federal government and the Federal Reserve have done extraordinary things to restart the market. They've already taken action in 2 months, 3 times greater than anything that was done in the entirety of the the Great Recession in 2008, in terms of pumping liquidity into the system, buying bonds, the Federal Reserve buying bonds, and the U.S. government, as we all know, with the CARES Act and more to come. So I believe that the shutdown in non-QM is going to be somewhere between 6 months and 2 years, not 7 years. And with that, I would like to hand it over to my colleague, Joe.
Thank you, Kevin. So, as Kevin mentioned, right now, in the last month, non-QM mortgages are essentially non-existent. We're starting to see some of them come back in a light capacity. So Sprout Mortgage and Citadel and Angel Oaks just announced their bank statement programs are going to be coming back. And what that is they look back at 24 months of bank statements and they average out deposits to determine income eligibility. For the last 2.5 years when I've been working with asset-based lending, the most popular program with investors, I would say probably 95% of the clients that we deal with, is they're looking for landlord loans, or what are called DSCR loans. And what those are they're no income verification loans, 30-year amortizations, no season requirements, no rent history, with 75 to 80% loan to value. Those loans are gone right now, and as Kevin mentioned, I have to agree. I don't think they're going to be coming back for 6 months, at least to a year. So what I want to touch on with everybody is, well, what are our options now? We're in a hard money loan. We just finished up renovations, and we want to get out of it, but we don't have the no income doc loans anymore. So what are our options? So what I've been telling people is we have really 2 avenues that we can go with this. Either we're going to end up going with a qualified mortgage, which is what Kevin touched on. And just to reiterate, qualified mortgages are bankable loans, Freddie, Fannie, FHA, they're agency financing that are full income verification. The qualified mortgages have recently had some guidelines that made them a little stricter, but they are still fully lending. And the stricter guidelines I'll go over momentarily. The second option for a lot of investors is to do what's more conventional commercial financing. All right, so that still would be under an LLC. You can go above 4 units. You could do mixed use. You could do full commercial. It's just going to require seasoning and to show stable income. So conventional commercial financing is a little more open-ended than, say, Freddie or Fannie or Freddie agency financing. It's a little more, the underwriting criteria is a little more gray. So what we'll do is we're going to go over kind of what the basics are that most banks are looking for commercial financing and go from there. So let's start with Fannie Mae. Fannie Mae and Freddie have very similar underwriting guidelines for investment properties. So here's some basics about the program. The nice thing is there's no prepayment penalty. The loans do report to credit. So because of that, Fannie's going to require that at closing, we transfer the property out of the LLC into your personal names at closing, all right? The property doesn't have to be rented, but if it is, we can use 75% of the gross rents to count towards your income. And if you have been self-employed more than 2 years, we can look at 1 year of tax returns. Now, Freddie is also 5 years, but it has to show growth. So the 1 year tax return program is great because right now we're in extension where I think it's July it got extended to, where we don't have to file still. So what you can do is talk with whoever it is that you're working with to determine what you really have to show for this year to help you qualify for takeout financing. I know a lot of people that are like myself, we're trying to, minimize income on paper. Unfortunately, right now, until these no-doc loans come out, that's going to be hurting your chances of getting qualified for upfront or takeout financing. And you can have a maximum of 10 Fannie Mae loans on your credit report. And this list over here, I won't read it out loud, but this is typically what we're going to ask for up front in order to get your initial approval and issue our initial disclosures. So, Fannie Mae qualifications. The DTIs on here, you can disregard. So this is for manual underwriting. Each lender has a right to kind of up and down it as long as they get an automated approval. So we as a bank, when we're doing either Freddie or Fannie, we're running what's called either DU or LP, which is an automated underwriting system. and that's going to determine whether or not the loan is going to be approved. Now, you obviously have to meet certain criteria, but it could technically deny you if you could meet all the criteria on paper, but if it's a very weak deal, it still could issue a denial. For a cash out refinance, our minimum credit score is actually 620. So we haven't upped our credit scores on any Freddie or Fannie lending. The only credit scores that we've increased is for FHA. Most banks are either stopping cash out refis or stopping limited cash out refis or raising their credit scores. We haven't made any adjustments right now. Our minimum FICO still is a 620. And the maximum loan to value is going to be determined by whether it's 2 to 4 units or 1 unit. So on a cash out refi, you're going to be at 70%. On a single unit, you're going to be at 75. And on a cash out refi, you're going to be at 75%. So that's Fannie and Freddie. Those are kind of the basics of it. I think more attractive for most investors is going to be to explore more conventional commercial financing. It doesn't weigh as heavily on your personal income to qualify. It's going to matter more about the property. You still have to show income, but it's not going to have a strict debt to income ratio, say like a Fannie Mae loan would. It's also not going to report to your credit. So this is the type of lending, though, that's a little more, it's gray. The underwriting criteria is going to change from bank to bank. It's going to change daily based on the bank's desirability to do lending. And it's all going to depend on where we place it and what day we're placing it. But if you can meet these criteria that we're matching on here, you shouldn't have any difficulties obtaining any type of financing. There's always going to be different banks that are doing something a little more aggressive, maybe higher or lower LTVs by 5%. FICOs might be a little higher or lower, but it's all going to kind of average out. So if you can meet these criteria, you're going to be in good shape. So a typical conventional commercial loan, you're looking at, it's normally not going to be a 30-year amortization. You're looking at a 20 or 25-year AM with 5-year resets. Like that's your basic conventional commercial loan. You can always try to negotiate or find a lender that's going to do a 20-year fix. But those are going to be, that's what you're typically going to be looking at. So how do we qualify people for conventional commercial loans? Now, you're going to want, first thing is going to be your DSCR ratio. So DSCR is the ratio between the expenses on the property versus what the income is going to be. But we don't only look at the property's DSCR here. They're looking at probably, I'm doing 4 separate DSCR calculations. I'm doing the DSCR for the subject property. We're doing an overall real estate DSCR. We're doing your personal DSCR. And then we're doing global DSCR, which kind of trumps everything else. So what is personal DSCR? Personal DSCR is basically we want to see that you can cover your own expenses. In Fannie Mae, it's a 49% debt to income ratio, strict, no negotiating at all. For conventional commercial lending, we just want to see that you have enough income to pay your personal expenses and survive adequately. There's no hard written rule on that. As long as you pass that, then the property DSCR has to make sense. Now, for what most people on the call are probably used to, companies like Vizio, Silver Hill, Sprout Mortgage, their DSCR was a 1-for-1. We're not going to be seeing that anymore. So the way that normally these non-QM lenders would say, okay, if the potential or current rental income covers the mortgage, taxes, and insurance, then the loan is approved. That's no longer going to be the case. So the way that we're going to look at DSCR now is we're going to look at what the rental income is going to be. We're going to add in the vacancy factor, what it would cost for a management company to come in, the property's expenses as a whole, plus the potential mortgage payment, and then we still want to see that profitability there afterwards. So the underwriting is definitely a little more, is going to be more strict. The typical seasoning period just to get one of these loans is going to be 6 months. And from what I'm seeing right now is that most lenders are capping it at 65% if it's owned less than a year, and 75% if it's owned more than 12 months. The units have to be 75% occupied. And if it's not occupied, I haven't found any lenders lately that are allowing us to use potential rental income. They're going to want to see that the property is going to be rented along with 1 month's rent to support it prior to closing. Otherwise, they won't use that rental income to help calculate towards the DSCR. And because of how strict these DSCR ratios, it's very uncommon that somebody's going to be able to get max LTV without having all those units rented. We typically are going to ask for 3 years of full federal tax returns. So does that mean we're going to average out 3 years of income? No. We're going to go off the most recent year's income. The purpose of asking for 3 years is to show stability. They don't want to see, that you made 5,000 one year, 10,000 one, and then this year when you just filed, you made 250. They're going to ask for good explanations that why there was such a jump or why there was such a decrease. So the purpose of that is more for stability. Or show fiscal responsibility. That's your personal DSCR like we touched on, and your FICO should be above a 660. So typical rates right now, what I'm seeing on these, so the non-QM loans, you were looking at 6% for 30-year AM, 5/1 ARM with a 5-year prepay. These rates right now for 20 or 25-year amortizations, we're seeing in the mid-3s. So that's a big plus. The loan doesn't report to credit, and you're not going to be limited to 1 to 4 families. There's no limit on the amount of units that we can go up to, and then we can also do mixed use or just straight commercial. The cons behind these, they take longer to close. So everybody who was used to 3 to 4 week closing times, those aren't going to be happening anymore with these types of loans. I'm estimating at least 60 days. Reason being is they take longer to do analysis on the income. They're going to, in most cases, they're going to want to do environmentals, which I'll touch on a little bit as to what exactly that is. And the appraisals take a little longer, especially in this climate right now. Just getting appraisers to go out there is difficult, or letting tenants to let appraisers into the properties is difficult. Something that I didn't touch on before is we're getting a lot for Fannie and Freddie, the QM loans. We're getting a lot of appraisal waivers, which is good, where we don't have to go into the house, or maybe we don't even have to do an appraisal at all. We're getting a lot of approvals to do just drive-by appraisals. Commercial financing, that's not going to happen. We have to get into each of the units, pictures, the whole 9 yards. There's no drive-by appraisals on these. The process on this is, your first step is we have to get what's called a letter of intent, which is basically an approval letter. And then that's when you pay for the appraisal, you pay for your environmentals, things like that. And it's a lengthy list of things that we need. But once you put together the list, we should be in good shape throughout the rest of the process. It's just waiting on the environmentals and the appraisals to get completed. So, when the non-QM market opens up, I would estimate that we're not going to see rates and LTVs where we left off. I mean, at our heights, a month and a half ago, I was doing 80% LTV on a cash out refi with rates in around 5%. I can't imagine it reopening it. We're going right back to that. I would, if I was to guess, I would say we're going to be somewhere around a 65 loan to value max with rates in the high 7s, low 8s. I hope it isn't, I hope we go back to the way things were originally, but I can't imagine it reopening and going right back to that. So it's just something to be cognizant of when you're doing your flips and you're aware that you need to refinance out of this, that you make sure you have enough equity in the deal to refinance under these stricter guidelines, because this might be the new normal for a while. Same thing too, if you're looking to sell the home, if you're looking to sell your home, our company has not made any adjustments in terms of debt to income for FHA loans. And most companies have actually raised the minimum FICO up to 660, 680. We've only raised it up to a 620. So if you have anybody that's looking to buy the home, if you're selling a multifamily, they're doing an FHA loan, they're having difficulty qualifying, we might be able to help them with that. And then the last thing is, I would say always get pre-qualified for your takeout loan before you purchase or get into the renovation, because you want to make sure that you're going to qualify under these stricter guidelines to get out of your hard money loan. So, Kevin, I think we can open up for questions.
Questions, anyone?
There have been a few questions raised in the chat. The first one, Joe, you just touched on it. Do you know what the current FHA interest rate is?
It's open-ended. I can't answer a question like that. I would need to see what the credit score is, the property's location, how many units is it? I mean, what the debt to income ratios are. I mean, if you want typical, a range, I would say the average is somewhere in low to mid 3s right now, but it's all going to depend on the scenario. It changes daily.
And there have been a couple questions about LLC seasoning for conventional commercial loans. One of the questions is, our LLC is less than a year old. For a commercial loan, can we show our individual tax returns?
We're going to have to ask for individual tax returns. The LLC can be just formed, that's fine. If for some reason, actually I should have mentioned this earlier, let's say you guys don't, like, you have no income on paper. You have two partners. You can bring on a third partner. And as long as they have 1% ownership interest, we should be able to use their income to help co-guarantee the loan. I would say typically you want to give them at least 20% ownership interest, but we do have lenders that will go down to just 1%. So if they're on the LLC, I can use their income to help.
Another question, this one's more of a general market question, but I'm sure a bunch of people are wondering and debating the same thing, is, does it make sense to buy now, or should investors wait to make purchases?
Kevin, I'll let you handle that one.
Well, I can only answer that if it were my money. And if you take what Joe just said, which is you're on the exit, you're going to borrow now 65, not 80, and the rates are going to be mid 7s to 8s, which I tend to agree with for the next 6 months. Then that implies in order for us as investors to make a return that the price of real estate has to go down. So my gut tells me that if they let everyone out in the next few months and the economy comes back quickly, then the dip in house prices will be brief. But if the recession goes on longer, then we're going to look at at least a 10% decline. So the answer is I would wait a little bit.
Kevin, another question for you that's come up a couple of times is ABL still lending?
Absolutely. We are still lending. We're a fund. We have capital. We've tightened up our standards. I think we're going to close around 4 or 5 million in loans this month, down a little bit, down from the previous month of 14. We've raised our rates. Our best rate for highly experienced borrowers is 10 and 2. That's up about 200 basis points from a month ago. And our LTVs we used to have a 90-75 program, that's gone. Now our best program is 85-65, 65 ARV. We also are requiring a 6-month interest reserve. But the answer is we are happy to make loans.
There's a question here about a pool loan or a blanket loan program. Joe, do you have availability for blanket loans?
Yes. Blanket loans are still available on the conventional commercial lending side of things. Fannie and Freddie, we don't do those. It's of course going to be case by case. Each property has to meet. I would say each property needs to be worth. For a blanket loan to make sense, I would say this: each property has to be worth at least $100,000, and you should have a minimum of 5 properties within the pool for it to make sense. But yes, we are still doing those. One more thing that I actually did wanted to mention in this is, so for conventional commercial financing, it's kind of like the old school way of doing banking, where you used to show up in a suit and try to impress the lender for money. It's where the presentation is actually important in this. And there wasn't me, but we had another loan officer in our company that sent a deal over to a local community bank, and the personal financial statement was written in pencil, and the underwriter denied it for that reason. They said, we don't like this borrower, and we had to basically reconfigure it and then send it somewhere else. So presentation is actually very important. Things being put together in nice Excel sheets, and then we can obviously coach and help, because this is going to be new for a lot of people, as to how to put that together. Like REO schedules need to look. It's got to be a nice, neat, and organized package, and of course we'll walk everybody through that.
Joe, there's another question here about the differences in terms for a cash out refinance versus just a rate and term and closing costs?
So a rate and term refinance is you're paying off your first mortgage plus rolling and closing costs, and then you can get a maximum of $2,000 back at closing. A cash out refinance is anything above that. So let's just do a quick example. You owe $100,000 on the property. We do a loan for $150,000. Your closing costs are $10,000, so you're going to be getting $40,000 back. That's a cash out refi. If we're just paying off the first mortgage, rolling and closing costs, then it is a rate and term. Rate and term refinances are always going to be better rates too, because it's less risky.
And Kevin, this one's for you. There's a couple questions about our current, some more detail on ABL's current hard money loan programs in terms of purchase, rehab, loan size.
So we range from 80 to 85% of deal costs and 60 to 65% of after repair value. It depends on the situation. New construction is 80-60, 80% of deal costs, 60% ARV. Fix and flip, we go up to 85% of purchase and rehab, capped to 65% of the after repair value. But if it's in a edgier neighborhood or an area where we deem to be riskier in terms of valuation, we might cap it at a 60.
And there's a follow-up to that about asking if ABL has adjusted experience requirements, how many past projects do they need to show, and how does it affect terms?
Yes. So we have adjusted experience requirements. Our best rate right now is 10% and 2 points, and that's for borrowers that have done 10 deals in the last 2 years. Our next bracket is 11% and 2 points, and that's for borrowers that have done 5 to 9. And then the final bracket is 12% and 2 points, and that's for 0 to 4 in the last 2 years.
And also a couple questions about how the interest reserve works. Can you explain that?
Yes. Simple example is we lend you $100,000 and the rehab is fully escrowed. The rate is 10%. That's going to be a $5,000 interest reserve. It's 6 months of interest, assuming the loan stays out for a year. That's a simple example. And you could use that if your rate is 12%, then it would be $6,000 interest reserve. It gets a little bit more complicated when you do a construction escrow, which for us is an escrow at $100,000 or more. In that case, we're going to take, say your rate is 10% and we advance $100,000 at close. So that's going to be a $5,000 reserve on the amount we advance at close. And then say your rehab is $100,000. Well, we're going to assume half of that. We're going to take the $50,000, which is half of the 100, and take the reserve based off that. So that would be a total reserve of $7,500 for that loan.
All right, I think that covers most of the recurring questions. So I think we'll end on that note. For all the people that have asked, we will make a copy of this webinar available after the fact, as well as Kevin and Joe's contact information. Any last words, gentlemen?
Stay healthy, everybody.
Yeah, stay healthy. Thanks, guys.
Thank you.